Growing financial strains and the collapse of numerous significant conglomerates are evidence that China is still fighting to keep financial risks under control. The fundamental flaw at the heart of China's financial system cannot be fixed by piecemeal regulatory adjustments, despite the regulators' zealous pursuit of a crackdown on financial risks. Political concerns will continue to influence credit availability, making it difficult for China to liberalize its financial system without introducing systemic hazards. As long as the financial sector is in its current suboptimal state of partial liberalization, China will struggle to sustain rapid economic growth. Theoretically, China's capital, insurance, and banking markets have all undergone significant liberalization. There are major distortions because the government affects how credit is distributed. State-connected borrowers have easier access to credit and pay lower interest rates than private businesses, while having lower productivity levels. State-connected businesses also profit from the expectation of government assistance in the event of financial troubles. The bond market in China offers a rough indication of this. The coming collapse, reality or repercussions? If you look beyond Shanghai's or the Wizard of Oz's curtain, you'll notice that China's double-digit percentage growth rates are an economic ruse that has been paid for with rising levels of bad debt and non-performing loans. China's bank debt was $3.7 trillion at the end of 2004, roughly double the country's GDP. The most significant percentage of any economy in the world is that. Additionally, almost all of that debt is lent by state-owned banks, with the Big Four providing more than half of it. More than $2 trillion, or almost the value of the whole Chinese economy, is currently owed to banks by Chinese state-owned enterprises, SOEs. Additionally, there are $500 billion more debts outstanding each year. Nobody who has studied communist economies will be surprised by anything. This is precisely how financial institutions operate in communist economies with soft budget constraints. That is the wisdom of the lone Nobel Prize-winning economist from communist Eastern Europe, the Hungarian János Kornai. Cheap loans combined keep ineffective state-owned businesses afloat in communist economies. They also indicate that many products that shouldn't have been created in the first place are created. You can see why the Chinese are selling Honda knockoff motorcycles in Vietnam for the price of their weight in scrap metal when you consider how inexpensive labor is in China. In the medium run, this might result in remarkable top-line economic growth rates, but it also resulted in the kind of significant resource misallocation that ultimately brought the Soviet Empire to its knees. As a result, the impending failure of Chinese banks is unavoidable. Additionally, it won't be the first time it's occurred. Two Guangdong banks failed during the Asian financial crisis of 1997, exposing the sizable amount of non-performing loans made to the Chinese red chips that were floated in Hong Kong. Investors selling shares of China's state-owned banks will undoubtedly claim that this time is different. But suppose you buy them drinks at a hotel bar in Hong Kong. In that case, they'll admit that a large portion of the improvement in the balance sheets of China's banks is due to the reclassification of risky loans worth hundreds of billions of dollars from non-performing to special mention, rather than any actual alteration in lending practices. Indeed, the Chinese government promptly quashed research by Ernst & Young that estimated the bad debts held by Chinese banks to be as high as $911 billion in 2005. That is not surprising at all. Governments run by communists excel at suppressing the truth. However, bear in mind that China's $1 trillion in foreign reserves, a global record, is hardly enough to cover its bad bank loans. Furthermore, before the bubble bursts, bad debts may reach $2 trillion because cheap loans finance a significant portion of China's 10% plus annual economic growth. Imagine the Chinese economy as the speed movie's bus. The Chinese economy is comparable to an explosives-rigged bus. It'll blow up if the speed dips to less than 50 miles per hour. The Chinese authorities have difficulty maintaining the bus speed over 50 miles per hour until the bomb can be, somehow, disarmed. If economic growth slows, SOEs won't be able to pay their obligations, and the banking system as a whole will implode. $1 trillion won't be enough to preserve it either. Here's the concerning thing. Eventually, the Chinese bus will run out of fuel. Additionally, compared to the Asian crisis of 1997, the Chinese economy now contributes far more to the global economy. The economic problems in China will affect the U.S. economy far more than the fall of the Soviet Union, whose economy made up less than 1% of U.S. trade in 1991. Ironically, the biggest threat to the world economy is not the inevitable rise of Chinese banks. Instead, it's their impending downfall. That is all for this video. Don't forget to like, comment, share, and subscribe to our channel to stay updated on more such content.